Welcome to this explainer. Today, we are looking at a genuinely fascinating public experiment in the world of finance called the THD Trading System. We're going to explore a very specific question. Is it actually possible to outperform the stock market simply by avoiding its biggest crashes? We'll see how a totally unique scientific framework is being used right now, tracking performance daily, in real time, to see if we can read the market in a completely different way. Okay, let's dive into this, because the question we're asking strikes at the very heart of how we're all taught to invest. If you've ever put money into the stock market, you've probably been told that higher returns absolutely demand that you take on higher risk. It's the classic Wall Street assumption, right? To get the big long-term gains, you just have to be willing to suffer through terrifying market crashes. But is that actually a law of nature, or is it just a stubborn myth? Section 1, the risk versus reward myth. For decades, the standard playbook for everyday investors has basically been buy and hold. Financial advisors tell us to just grit our teeth and endure those painful bear markets. It's all built on this old rule. You must tolerate the full declines to earn the full returns. You're expected to just wait it out, hoping long-term growth eventually fixes your short-term losses. Well, the THD trading system was built specifically to test if this absolute trade-off between high returns and painful losses is actually true. Does it really have to be this way? Section 2. Enter Informational Physics. To challenge that old rule, we have to look at the market through a completely different lens. And this brings us to informational physics. Instead of looking at the stock market as just a squiggly line randomly moving up and down on a chart, informational physics treats the market like a physical structure. Think of it like a giant bridge. Before a physical bridge actually breaks, it doesn't just snap without warning. It groans, it bends, it shows measurable signs of stress and pressure. Informational physics suggests that financial markets do the exact same thing. They show observable behavior, like structural deterioration and instability, long before they actually break down. Now, we absolutely have to give credit where it's due here. This entire framework and the rigorous research behind informational physics was originated by Kevin L. Brown, a dedicated researcher, inventor, and author. His work provides the foundation for treating the market as a dynamic system with actual boundaries and limits, rather than just a random walk of prices. So the crucial point is that the THD system doesn't try to predict tomorrow's stock price. I mean, nobody has a crystal ball. Instead, it just reads these structural signs to ask one simple question. Is it safe to stay fully invested right now? It looks at stages like emergence, where a structure expands, contrast, where it faces pressure, and integration, where it stabilizes. When multiple signs of structural damage pop up, the system recognizes that the bridge is under way too much stress, and hey, it might be time to step off. Section 3, the math of losing money. So, why is stepping off that bridge so vital? Well, it comes down to a painful reality known as loss asymmetry. When you lose money, it takes a much larger percentage gain just to get back to zero. For example, if your portfolio falls by 10%, a 10% gain doesn't fix it. Actually, scratch that, it's worse. You need an 11.1% gain just to recover to where you started. And this brilliantly illustrates what happens in a true crash. If the market drops by 50%, which, by the way, has absolutely happened, you don't just need a 50% gain to recover. You need a massive 100% gain. Your remaining money literally has to double just to break even. This proves that avoiding a massive market crash is mathematically way more powerful than trying to perfectly time every small market jump. Section 4, the historical proof. Knowing this math, the creators of THD went back in time to test their theory. They set up a very simple conservative test. You see, the THD trading system doesn't try to pick the best individual stocks or use risky borrowed money. It simply shifts between two choices: holding the broad U.S. stock market or moving completely to cash when the structural stress gets too high. Now, what's really interesting about this historical comparison is the hard data. When we look at the numbers, the results are fascinating. The historical performance of THD, compared to just holding the market, really stands out. If you track the top performance of the optimized THD system against the standard buy and hold approach right below it, you see a completely different story unfold. Let's deconstruct those numbers for a second and isolate the most important one: maximum drawdown. This simply means the biggest drop your portfolio would have taken from its absolute top to its very bottom. While the standard market strategy suffered a horrifying 55.19% plunge during its worst period, the THD system's maximum drop was only 18.50%. It vastly reduced the pain of the crash. But here is the major myth-busting revelation. Remember that old rule that said you have to suffer the 55% drops to get the big rewards? Well, historically, THD produced an average yearly growth of 12.50% compared to the market's 10.77%. Let that sink in. It historically produced higher long-term growth while taking on significantly less risk. It achieved more return precisely because it didn't have to dig itself out of those massive 50% holes. This outcome is a direct challenge to a huge idea in finance known as market efficiency. A lot of experts strongly believe that you literally cannot systematically beat the market using historical data because they think all past information is already baked into today's prices. THD serves as a fascinating counterexample to this. It suggests that hidden structural information, the stress on the bridge we talked about earlier, might actually be there for us to read.
Section 5. The real-time experiment.
But here's the catch, right? Looking backward is easy. Historical backtesting can be manipulated because you already know exactly what happened. There is a massive scientific difference between retrospective testing, proving something was possible in history, and prospective testing, proving it will work tomorrow when the future data is totally unknown. Let's move on and see how this builds. To prove this works in the unknown future, Kevin L. Brown and his team created a frozen system. The rules of THD are now strictly locked in. There's no changing the rules if the market does something unexpected, no hindsight allowed. It is now a public laboratory experiment running on unknown future data, and it tracks its performance daily in real time. And the absolute best part is, you don't have to just take their word for it. You can track this ongoing, real-time experiment entirely for yourself. You can follow the daily market states and try the free THD trading system in action by visiting creationunified.com. Which brings us to the ultimate question for the future of investing. The experiment is live, the data is flowing, and the rules are completely frozen. Can structural information truly make the market easier to read? We invite you to follow along and find out for yourself. Thank you so much for joining us for this explainer.